From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Equity markets are cautious. We're 24 and a half hours away from the CPI print. Who should be more nervous? Bonds or stocks? Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up in the show, futures hold ahead of tomorrow's crucial inflation data. Houthi rebels carrying out one of their largest attacks to date in the Red Sea. And you got it, Bitcoin is in focus after a fake post on the SEC's Twitter account. Can you believe it? We begin with the only issue, counting down to the US CPI.
We'll see the CPI report on Thursday.
CPI
is going to be, critically important here.
The Fed keeps telling us every CPI matters.
CPI number could be very influential on that market pricing on rates.
If inflation is moderating, I think it's important for the Fed to adjust their policy stance.
If inflation keeps falling, they will deliver those cuts, probably starting relatively soon.
Inflation is coming down.
It's splashing down.
On a glide path lower.
The risk would be those rate cuts get priced out because inflation kind of turns higher.
Do we get a slight reacceleration?
There is a risk here that we see a reacceleration.
The market is dead set on believing the Fed is going to ease. I don't think a lot's going to change that view.
We're in this immaculate disinflation, but it's not going to be a straight line down.
We are not out of the woods when it comes to battling inflation.
We need to watch inflation.
Joining us now to discuss the risk on the board over the next 24 and a half hours, it is Schwab's Colin Martin and Krishna Memani of Lafayette College. Good to have you both with us. 24 and a half hours away. We'll know what the trajectory is or was for inflation. But the markets are resetting. We're being told to lighten up on global risk. I have Luke Hickmore with me. Yes, he's saying, be careful. The temptation is to neutralize everything. So let's take it to you. First of all, Krishna, the risk is to the downside for you at the moment.
Yes. So I think the focus on inflation, at least the CPI to some extent, is, I think, misplaced. I mean, it's an important number. But the number that matters for the Fed is core PCE. And the trend in that is pretty well established. And it probably goes lower. So I think in most, at least in my conjecture, the print tomorrow is probably going to be irrelevant. The bigger question, however, is how is the market positioned? So if there is any bit of softness, I think the market is positioned totally against that particular outcome. And therefore, the risk, the pain trade for the market, I think, is really 10 years at 3% in the first half of the year. That really would be a really bad outcome for a lot of steepeners that people have positioned for. And in that environment, equities probably don't do well either. So that's really the pain trade for the market, I think.
Okay, well, to get to 3%, a heck of a lot has got to go wrong, or else there's got to be a heck of a lot to go wrong and a lot of rate cuts. Let's take it across to you, Colin. Let's square away. Do you see a risk of 3% on bonds in the first half of the year?
We don't see that risk, Manus. We think 10-year Treasury yields at 4% are right where they should be. Now, it doesn't mean that there can't be a lot of volatility. In fact, we do expect a lot of volatility as we sort of get that push and pull between Fed projections and what Fed officials are telling us versus the aggressive pace of rate cuts that the markets are forecasting right now. But when we look forward at potential for a soft landing and the potential for the Fed to gradually reduce interest rates, we think 4% is kind of fair value for the 10-year Treasury yield. 3%, as you kind of alluded to before, it would take a pretty dire turn for the worse, I think, to get a number that low. We need to see a sharp loosening in the labor market. We likely need to see the unemployment rate rise pretty high and pretty quickly. And we need to see an indication that economic growth was slowing pretty quickly. But right now, we're just not getting that. I mean, even though we're expecting to see fourth quarter GDP decline a little bit, if you look at the real-time nowcast from various Federal Reserve banks, it's still around 2%. So that's not our base case. We think 3% in the first half is probably a bit aggressive.
A little bit rich. Well, let's set out the stage for the CPI. It's going to be a battle royal between CPI and PCE. Let's bring in Mike McKee into the conversation. We've got a Treasury auction this afternoon as well, and we're seeing international Treasury auctions being snapped up by the Brits and by the Spanish markets. Mike, set the table.
Well, now we're going to have the American market come into play here. $37 billion worth of 10-year notes in a reopening this afternoon. It's one of the issues that occasionally gets attention but doesn't get a whole lot, and that is the impact on bond yields from the U.S. deficit. And the U.S. deficit has to be financed, but the biggest buyers are all getting out. It's not just the U.S. deficit. You can see the European Central Bank and the Bank of Japan, they're all ending their QE programs, and their balance sheets are shrinking, so they're not the buyer of last resort anymore, which means somebody else has to pick up the slack. Now, this all means that the rate of interest that everybody has to pay, all these countries have to pay on their debts, has been going up because bond yields have been going up. But is it because countries are having to pay up, or is it because we're seeing a lot more debt? It's hard to separate those two things out. You look at what's going on with the 10-year note, and you can see what happened earlier this year. Note yields rose a lot, and then you can see when they start to go down right at the beginning of November, a lot of credit is being given to Janet Yellen's announcement, the Treasury's announcement, that they were going to shorten the maturities in their auctions, sell a lot more bills, 2 years, and get away from the long end, and yields came way down. They've started to go back up again. Is that a sign of some concern? Look at the when issued for today's auction, and it's basically almost on the screws with the current on the run. So it doesn't look like there's a lot of problems going into this auction, but we will find out this afternoon whether demand is such that Treasury has to pay up. It's come down. I mean, the whole structure's come down along with the on the run 10-year over the past 24 hours.
Mike, it's the debate for 2024, isn't it, in terms of the supply versus the inflation narrative. Mike McKee there with the very latest. We'll see how that auction goes and bring those results to you through the day. Colin Martin and Krishna Memani are my guests this morning. Colin, I want to come to you because the debate is about term premium and curve steepening. That's so far. That's the momentum that's come through from the various guests that I've spoken to. You are more concerned about we will return to our morbid fascination of rising deficits and rising supply. We might not get indigestion today, but we've got $2 trillion coming down the pike in the very near term in issuance. Is there a risk, a serious risk, that we go back to looking at deficits and supply more materially?
We don't see that as a risk right now. It doesn't mean a lot of other people might not start being concerned, but it's not something that it has kept me and my team up at night for the past number of months. It's funny, when we went back to the late summer and fall surge in yields, it's all we heard about. With that reversal, we don't get too many questions about it lately. When we look at the relationship between deficits, the amount of debt outstanding, supply concerns, we just haven't found a relationship between a change or level in Treasury yields. Now, it doesn't mean that historical relationship can't break down at some point down the road, but for up until now, we just haven't found that relationship, so we're not too concerned. And one other point, there's a lot of talk about Yellen and how she manages, the government's finances, but I think it's important to point out that Treasury isn't your typical, household or corporation in terms of how they can issue or what types of maturities they can issue. For example, when rates were very, very low, there's a lot of talk about how she should have extended duration. Well, when you have trillions in debt, what's the appetite for that sort of maturity? So there's only so much the Treasury can do, and I think they're kind of tweaking it at the margins. And if we look at auctions like we're seeing today, there can be some movement here and there, but we're not expecting a surge in yields anytime soon because of those deficit and supply concerns.
Okay, just very briefly before I leave you, Colin, would you pick, you said 4% is fair value. Would you pick up duration, or would you go to the shorter end of the curve and just clip up T-bills?
We still like duration, Manus, but we kind of have a bigger picture perspective because a lot of our clients at Schwab are individual investors. They're not really looking to make tactical trades. So a balanced view, but yes, we still like duration at current levels.
Krishna, we've got John Williams today, New York Fed, pretty important when he speaks. That's the directionality. What will he What do you think he should be saying to the market today?
Well, so John Williams was the guy who was kind of sent out to walk back Powell's commentary. So yeah. I think he would basically say what he said in December, which is, yes, we have rate cuts coming, but we are not there yet. And I think that has been his situation. I think what would be interesting is if he actually talked about QT and slowing down the pace of QT, because I think he was probably, other than Lori Logan, he was probably the other member who was talking about QT. And I think if he focuses on QT, that'll basically, or slowing down QT, I think that will give you a really good clue that the Fed is basically thinking about that far more seriously than what we have known so far.
Okay, well, we're going to come back and talk about what that might mean for markets in just a moment. Stay with me, gentlemen, Colin Martin and Krishna Memani, my guests on the markets. Joining me now to look at the stocks ahead of the opening, it is Katie Greifeld.
Let's talk about NVIDIA extending its winning ways pre-market. It's CES week, of course, the big show out in Las Vegas. NVIDIA unveiled 3 new chips earlier this week. Shares a little bit higher right now, 0.7%. or so. Let's talk about Meta. There's not too much movement here, but the news there is that Meta will pay Israel's competition authority a nearly $7 million fine. That's after it was accused of failing to report 2 acquisitions. Meta moving a little bit higher, though, and Coinbase following Bitcoin lower today after the SEC's X account was hacked last night. It posted a tweet saying that the SEC had approved spot Bitcoin's ETFs. It has not yet. Maybe later on today, Manus, but Coinbase currently down pre-market.
I just want that story to happen, Katie. That's all, so we can all emotionally move on. Katie Greifeld will catch up with you a little bit later in the show. Coming up, simmering tensions across the Middle East.
Every partner that I met on this trip said that they're ready to support a lasting solution that ends the long-running cycle of violence and ensures Israel's security.
Oil prices remain volatile as traders digest the latest developments out of the Red Sea. That conversation in just a moment.
Every partner that I met on this trip said that they're ready to support a lasting solution that ends the long-running cycle of violence and ensures Israel's security. But they underscored that this can only come through a regional approach that includes a pathway to a Palestinian state. These goals are attainable, but only if they're pursued together.
Houthi rebels launching one of the largest Red Sea attacks to date. US and UK warships shooting down 18 drones, several missiles, all aimed at critical commercial shipping lanes. Meanwhile, oil is rising. Choppy session there as the attacks raise the risk of supply disruption. Team coverage on this. Bloomberg's Kayleigh Lyons in Washington, D.C. Will Kennedy in our London HQ. Kayleigh, let me bring to you first of all. These attacks, they are mounting, putting more pressure on Secretary Blinken as he's there in the region right now to show America's commitment. But it's show and tell, isn't it?
Yeah, that's absolutely right, Manus. It was just days ago that Blinken, on his trip to the region, the 4th he has made since October 7th, warned of consequences for the Houthis if these attacks were to continue. And yet what we are seeing is the attacks continuing, and as you say, actually intensifying, as this was the largest we have seen. 18 missiles, 18 drones, 3 anti-ship missiles that were shot down by U.S. and U.K. military forces in the region. Of course, this region being so crucial in terms of a global trade waterway. And this is despite the defensive and deterrent presence of the U.S. and U.K. navies, and not just them. We obviously have a coalition of dozens who are trying to protect the Red Sea. To this point, though, it isn't working, which raises the question of what exactly the consequences that the U.S. and allies are warning about actually are and whether they will ultimately be enforced. Bloomberg has reported that the U.S. is considering directly striking Houthi targets in Yemen, but there is much concern that offensive maneuvers like that may further escalate tensions in the region, considering the Houthis, of course, are an Iranian proxy, and intensifying fighting with a proxy could make it more risky of a potential accident or direct confrontation between the U.S. and Iran. And that's just the consideration on the adversary side. There's also the consideration of how allies in the region may they feel about this. We know the Saudis, Saudi Arabia, prefer a more measured approach to the Houthis because of the retaliation they have faced from that group in the past. So it's very difficult for this administration to navigate. We haven't heard from the White House on this specific incident yesterday yet, but we'll be looking to see if they do suggest that more force may be coming.
Okay, well, that's the geopolitical side. Will Kennedy, as ever, translates geopolitics and will explain to me why there is no geopolitical premium in this price. We have touched on this several times, Will, before Christmas, after Christmas. And I know we've done several interviews, which is there's supply coming from everywhere. That was Mike Muller's line, wasn't it, in terms of the push and the pull in these markets. So with the latest developments from the Houthis, will there be a sort of a flash of light come into the oil traders' eyes?
I think the oil market is aware of the risks here, and there are times when it has moved the price higher, but there are several points to make. One, the Houthis have not targeted oil tankers. It's been increasingly clear that almost exclusively they've targeted the container shipping industry, and by and large, oil has managed to move unmolested through the Red Sea and the Suez Canal. Two, I think that there is a lot of spare capacity out there. You made the point that Mike Muller made, that there's a lot of oil coming, but he said that, you know, OPEC will try and keep strong demand balanced with robust supply. But the fact that OPEC is managing the market, that it has built up a fairly large margin of spare capacity, means that there is a cushion against something more drastic happening. There is oil that's not being pumped by Saudi Arabia and the UAE that could come back into the market in extreme scenarios. That's reduced. And the final point I would make is, yes, the Houthis launched an unprecedented barrage, but they shot down all 18 missiles. So the Western response today was working. And I think you put those factors together, and that's why you're only getting the very modest uptick that you're showing on the screen there.
Good to see you're a bit more phlegmatic about the situation than I am. But you're right. You are right. It is a demonstration, isn't it, Kayleigh, that this coalition of the willing in the Red Sea, it is working. Kayleigh Lyons in Washington. She's got a busy time with caucuses. Will Kennedy just has a busy time with the commodity and oil markets. Colin Martin and Krishna Memani is with me. So, in part, no war premium in the oil market, and certainly no sign of global geopolitical angst in the bond market. Is that a misnomer? I mean, this year we've got, I looked at a map yesterday, there's hotspots all across the Taiwan Straits, there's hotspots to the east, there are hotspots in the Red Sea, and yet this bond market is only focused on inflation. So, Krishna, we just don't pay attention to war until it really is at a critical level. Is that correct for the bond market?
Yes, and I think to some extent it's justified by what has happened in the past. We have had these situations for a long time, and I think in this go around with the war in the Middle East, things are a little bit more volatile for sure. However, I think if you, as the previous speaker said, if you kind of look at what the Houthis are doing, it certainly isn't. It's more show than in reality actually changing things dramatically. And another point to make in that regard is clearly going through Cape of Good Hope increases the shipping cost to some extent. But I think the right way to think about that is it's more of a tax than really a big impact on inflation. When people equate it to supply chain disruption during COVID, that was driven by a whole hell of a lot more than just container prices going up. And I think even today, the container prices have gone up, but very modestly so. We have had episodes where shipping costs were higher and it didn't really have any inflationary impact.
Colin, you know, there we go. Geopolitics. For as long as I've been around, you know, we don't trade geopolitics is the mantra. But when you look at these markets, what is the sort of the worst case scenario? Is it a growth shock to the downside? Is it a less potent Federal Reserve? I mean, there's any cacophony of events. But if the bond market won't price a war premium, what should it be more concerned about?
Well, when we look at the risks to the bond market and specifically the credit markets, which we've been looking at lately, we see plenty of risks domestically. And as you've alluded to, the markets just aren't pricing in too many risks right now. I mean, coming into last year, we were concerned about tightening bank credit standards, the rise in corporate defaults, the inverted yield curve. markets have shrugged those off, and credit continued to do really well. And as we fast forward today, where we see a lot of these geopolitical risks, the markets continue to shrug them off. You look at investment grade and high yield spreads, both remain there near their year-and-a-half lows. Now, if we continue to see these geopolitical risks kind of converge, bubble up, and become something bigger than they are right now, then that is something that could result in spreads moving a little bit higher, along with all the other things we're focusing on right now. But long-winded answer, Manus, but to your question, I think it'd be a downside to the growth outlook if these things were to have an impact on global trade.
Listen, credit, everybody's coming on and say you want high-grade credit, investment-grade credit, $30 billion of credit will hit the table this week. So let me put that to you, Krishna. Would you prefer credit relative to sovereign on the book? I know you're calling 3% on U.S. Treasuries, but I just wonder what 3% Treasury yields would mean for credit. Bit of a pop?
So no, I would say pop for spreads rather than support spreads. Right now, the markets are singularly focused on a soft landing, and they're pricing that everywhere, in equities, in credit, in treasuries. My point is, if you look at positioning in the marketplace, the risk is to the downside in treasuries rather than upside. I can't come up with a scenario where you have a meaningful reacceleration of growth or inflation. So it's really, we are at 4% with substantial risk that we go lower than 4% rather than go back to 4.5%. In that context, I think government bonds are probably the best place to be because it gives you decent amount of yield and helps you participate if things slow down a bit at all.
Krishna, you'll get a wee phone call from Stephen Major. You can have a bomb boys night out. Don't worry, Colin. They'll invite you along for a bit of credit as well. That is the team on the markets: Colin Martin and Krishna Memani. Coming up on the show, your morning calls, and then Sarah Hunt joins me from Alpine Saxon Woods. Her outlook on the markets. That conversation in just a few minutes, right here on Bloomberg from New York. Good morning. Down to the open. I'm Manus Cranny in for Jonathan Farrow. Time to get your morning calls. Look at what the analysts are saying on the street. First up, Redburn Atlantic downgrades Apple to neutral, pointing to regulatory headwinds and the stock's rich valuation. Next up, Goldman Sachs downgrades Etsy to neutral, seeing limited visibility on the growth for this year. And finally, Wedbush upgrades Home Depot to outperform, expecting the shares to benefit from strengthening demand. Coming up, Sarah Hunt from Alpine Saxon Woods, I should say, joins me just after the opening bell. Counting down to the open, you've got a little bit of green there. Are we living on a prayer? Are we living on a prayer that CPI is going to come in on the lower side? There you go. We're going to roll it over and have a look at the opening trades. Do you go for a little bit of breadth? My guest just a moment ago said bond yields will trade down to 3%. What would that do to your NASDAQ if you see a collapse in bond yields? That couldn't be very good for the economy. There is the opening bell. We have a hint of green across this screen. We're 24.5 hours away from the CPI hitting the tape, and your risk is, of course, that it could surprise to the downside. That may well embolden the rate cut narrative again. Flat on euro-dollar. Yields are sub 4% in the United States of America. 3.99 is where they trade. Crude ekes out a gain of 122 as there's some draws on stocks. But there is one stock equity to keep an eye on. It is Boeing. The shares are coming off a two-day decline of 10%. This is the CEO, Dave Calhoun, addressed his workforce.
We're going to approach this, number one, acknowledging our mistake. We are going to approach it with 100% and complete transparency every step of the way. We're going to work with the NTSB, who is investigating the accident itself to find out what the root cause is. I have a long experience with this group. They're as good as it gets.
Katie Greifeld is with us with more on this story. The question goes through my mind. I've seen several CEOs deal with these kind of situations is, can he last? Katie?
It's a good question, and what we know so far is that we got an emotional mea culpa from the Boeing CEO yesterday. That was given during an all-hands meeting with employees on Tuesday, of course, following last week's incident where you saw a door plug eject from a 737 MAX 9 mid-flight. Now, in the days since, U.S. regulators have since grounded Boeing's 737 MAX 9 aircraft in addition to ordering inspections. And already you have Alaska Air and United Airlines both discovering loose bolts on other 737 MAX jets. So safe to say this story isn't over yet, particularly not for Boeing shares. We are seeing a little bit of a bounce right now, but already in 2024, shares down more than 13%. If it's any comfort, Boeing bulls on Wall Street would tell you that this is a manufacturing issue. It's not a design issue. So maybe not an existential threat, but the 737 MAX is Boeing's biggest revenue source, so certainly hard to ignore, Manus.
Okay, Katie. Well, it's certainly being taken to task by Michael O'Leary at Ryanair and Tim Clark over at Emirates. So the CEOs of the world certainly are forming their opinion. Katie Greifeld with the very latest on Boeing. Let's turn our attention to the home builders. We have Lennar increasing its quarterly dividend, boosting the buyback. Must be music to the market's ears. An additional $5 billion. Simone Foxman can tell us whether they're rejoicing at Lennar.
Well, certainly investors in Lennar are. Shares look up 4.5% so far in early trading. The annual dividend now $2 versus the $1.50 that it had been previously. And about that buyback program, that really seems to be the focus of analysts this morning. Chairman and co-CEO Stuart Miller saying we are focusing more of our capital allocation on maximizing total shareholder returns. Barclays says this is the clear positive that investors have been waiting for. The company's been shifting to a more asset-light model, as have home builders generally, and this is driving the improved valuation in its view. This is following D.R. Horton raising its dividend by about 20% back in November, and the rally continues for home builders. We're looking at shares of D.R. Horton, Toll Brothers, and Pulte Group also rallying in sympathy with Lennar this morning. We've seen a recent drop in mortgage rates. That's beneficial as well. And this morning we got data out on mortgage applications rising by the most since June last week. All of this adding to this narrative. There just aren't that many existing homes for sale. So everyone who wants to buy a home, they've got to buy a new home. Lennar, we saw rally 65% in 2023. It's already up over 10% this year, Manus.
Okay, Simone, thank you very much. Certainly doing well this morning, up under just 4%. Turn our attention to financials now. BlackRock announcing yesterday that they will cut 3% of the workforce as a result of dramatic shifts in the industry. Alex Semenova joins me now. So this is a 3% cut today in preparedness for the future.
Indeed, Manus. Unprecedented changes in asset management. That was the message communicated by BlackRock executives to staff yesterday as they announced a fresh round of layoffs. The world's largest asset manager is cutting 600 jobs, or 3% of its global workforce. Important to note here that this isn't about downsizing, but rather a reallocation of resources to keep up with a rapidly changing industry. In fact, CEO Larry Fink and President Rob Kapito said yesterday in the memo that they actually expect their headcount to be larger at the end of 2024. BlackRock is expected to report an increase in assets under management when it reports earnings on Friday. But more broadly, the industry has faced somewhat of a reckoning in the past 2 years. First, amid a rout in stocks and bonds back in 2022. And then last year, of course, as investors worried about higher interest rates. That's seen BlackRock and some of its peers, including Wellington Management and T. Rowe Price, cut jobs and redirect their budgets. BlackRock's goal has been to become a one-stop shop for various investment vehicles, including equity funds and private assets as well. Shares of BlackRock were down just over 2% as of yesterday's close. That's after a 15% gain last year, with those gains concentrated in the second half of the year as investors expected rate cuts this year. Manus.
Well, let's see if they get their ETF status from the SEC for Bitcoin ETFs and what they charge. Alex, thank you very much. That will be the story of the day. Finally, let's turn our attention to big tech. You've got Apple. It's been hit by the third analyst downgrade in a month. This one coming from Redburn Atlantic, citing valuation concerns. Isabel Lee joins me with a little bit more. Everybody's taking a swipe at Apple, eh?
Hi, Manus. Yes, correct. This is the third downgrade in the span of 2 weeks for Redburn. It said that even if the iPhone is expected to return to growth in 2024, the upside will be limited in the next few years. It also said that there's regulatory risks may impact Apple's, quote, ability to monetize its ecosystem. So this is the third downgrade. Last week we saw Piper Sandler downgrading Apple for weak macroeconomic environment in China, as did Barclays. So Apple is already the least loved tech stock on Wall Street. Among all of its mega cap tech peers, Apple has the fewest buy rating. And it's the only big tech firm last year who saw 4 straight quarters of contraction in the revenues. The stock has rallied around 50% last year, but year to date, it's up around 4% this month. For now, though, it's down around 0.3%, Manus.
Isabel, thank you very much. Great roundup and synopsis of the latest downgrade. So earnings season, it is upon us once more. The results, they will be pretty much dependent on growth, size and scale of the Fed pivot, if and when it comes, as well as the clarity around the directionality for the dollar. Now, Goldman Sachs are penciling in an earnings per share forecast higher than the median. In the meantime, you've got the analysts already slashing their estimates over the past few months, getting ahead of the bad news. That's thanks to Danny Berger this morning on Bloomberg Brief. Earnings will now go up 1.2%. Is that enough to cause Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods, to shake, shudder, or reflect? Sarah, good morning. I wouldn't say you're the kind of lady that shakes or shudders in the face of a small downgrade on earnings, but should I be nervous? Should we be nervous?
That the fourth quarter earnings are not really going to be as much in focus as what people say and what companies say on those fourth quarter earnings about 2024, right? Because the earnings season is always behind us. It's the expectations going forward. And we've got some pretty juicy expectations built in, we collectively as consensus, for earnings growth in 2024. And I think that that's really going to be the biggest question, is whether or not that can come through, given the fact that we saw so much multiple expansion last year.
So if these earnings perhaps are weaker than we think, and it's about the guidance on the consumer and the guidance on the global outlook, can I expect, we've had a brutal start of the year, the worst start of the year across assets in 20 years. So do you expect a further drawdown, or maybe even, dare I say it, the scale could be a correction?
I think that the possibility for a correction exists, but you'd have to see something larger change in the economy. Right now, there still is an overall feeling that the Fed has navigated this. Rates are going to come down. The concerns that we saw in September and October of last year, that rates were going to stay as high as 5% on the 10-year and that much higher for longer, seems to have backed off. And I think that right now we're in a period of, we had 2 fantastic months at the end of 2023. We're in a period of figuring out what's going to happen in 2024. I don't think you're going to get a huge amount of commentary. No one's going to say, you know what, I think 2024 is going to be a terrible year. The fourth quarter, people started to set the stage for 2024. We really have to see what happens in the economy and how that data comes through.
I think we have to see what Don Jamie says to us in terms of projecting forward, and we'll hear a little bit of that hopefully on Friday. Now, to understand the trajectory for 2024 is to understand the scale and the size of technology in my portfolio and whether I go for breadth or Mag 7. So within the valuation narrative, first of all, set the stage for me. You say tech overall at the headline looks rich.
I think it does. You saw a lot of multiple expansion in 2023. That's really where the gains came from. They didn't come from huge earnings growth across the board. Now, they did in certain circumstances. So something like NVIDIA had huge earnings growth. But I think that the biggest issue is going to be what happens going forward with those actual earnings. And so, you can't get away from the top technology stocks. They've got incredible business models. They've got incredible cash flow. The question is, do you start to see some of the rest of the market catch up to that? And do you see some of the cats come through for other companies as well? And I think that, you don't want to run away from big tech, but I don't think it's going to be as important this year as it was last year, just because you had such incredible outperformance last year.
Which may well mean that you go for slightly bigger breadth on the tech. I do want to get your opinion. It's slice 3 of a go at Apple by the scribes. Today, it is Redburn downgrading. They still got a price target of $200. Piper Sandler worried about iPhone sales. And you've got Barclays going underweight on the stock. I've had various people say, oh, just load up on the dip, buy it, stack it away, and think about it as a cash generator over the next 5 years. I know you hold Apple. What can you say as this narrative builds up? It's a wall of worry, and worry can turn into something much more parabolic on the downside. I've seen it before. Is that my risk?
I'm not sure you're going to get a parabolic downside on Apple. I think it's the easiest one of the larger tech stocks to pick at right now, just because there has been, unlike a lot of the other tech companies, the earnings growth has not been there in the near term. And there's some concern about that going forward, especially on the hardware side. I think the bigger issue is, you've got this ecosystem I think the question about the regulatory issue is going to be a problem, and I think, or an issue at least for people to contend with. And I think that you still have a lot of growth on the services side, and there's incredible margins on that side. It's got an incredible, unique ecosystem that continues to grow. So it's really about owning that franchise. And right now, is there some concern where the multiple is relative to where it's been historically? A little bit, given the fact that growth really isn't there. So I think it's an easier of the big tech stocks to pick on right now. And I think that longer term, we like it. But I think that you could see some digestion in the near term, especially given that multiple.
You mentioned operating margins, and this is in part what the team here have been writing about, Gina Martin-Adams and Gillian Wolfe, talking about the disinflation narrative and the impact that can have on operating margins. Who is most susceptible? I mean, first of all, I would presume, or I'm assuming, that you're on the disinflation train. So to that extent, how does disinflation impact margins and therefore reflect on allocation?
Well, I think that if you stay with a disinflationary trend, and I would say that there are pockets where you could get issues where that's not so helpful, right? So energy could change. It hasn't changed yet, but it could. So that impacts transportation in a lot of different areas. The whole problem that's going on right now in the Middle East affects transportation, and that affects pricing. But on a disinflationary scale globally, it does help margins, because as those good prices come down, the fact that labor prices are coming up, you may have a trade-off there. And the big concern when goods prices weren't coming down was that as labor prices came, margins were going to get squeezed. And historically, corporate profit margins are at very relatively high levels. So I think that that's been the issue, and whether or not that can continue, they can continue to take costs out, which they've been surprisingly effective at. That is going to dictate to some degree what happens with earnings in 2024.
What could be the biggest surprise this year? I mean, there's certain narratives that have built up in this first 10 days. One is de-risk. Two is don't be a hero on credit. And finally, of course, it is that the Fed may not cut 6 times as the market wants. What's the biggest outlier risk in 30 seconds for you?
I think the biggest risk is where interest rates go. And I think the idea has been we're going back to this very low interest rate environment that we had to the financial crisis, maybe not to zero, but we're certainly coming down a lot. I think if we stay higher than people expect, and that's the real tension between what the Fed is telegraphing and what the market expects, then I think that the fact that money has a cost may impact a lot of the valuations that we see across many different asset classes. That's really a question that's still up in the air, though.
Sarah, thank you so much for being with me this morning. That's Sarah Hunt, Alpine, Sachs and Woods. Her comments on the markets and Apple. Coming up in the show, you got it. Bitcoin is in focus. It was a fake post on the SEC's Twitter account. Brutal.
Bitcoin and crypto are still going to have no legitimate use. They're still going to remain the preferred product of speculators, gamblers, predators, and criminals. And they're going to continue to be cesspools of fraud, manipulation, and criminality in the trading of the spot market.
That conversation next on Bloomberg.
Bitcoin and crypto are still going to have no legitimate use. They're still going to remain the preferred product of speculators, gamblers, predators, and criminals. And they're going to continue to be cesspools of fraud, manipulation, and criminality in the trading of the spot market. I think this is going to be viewed by history, and not distant history, in the next few years as we see crypto carnage hitting Main Street investors and Main Street people saving for retirement, getting into this very volatile asset that's full of fraud.
Crypto carnage, is that what is ahead? Well, the SEC still has not released its decision on the approval of the Bitcoin ETFs. But a breach in the Commission's X account said otherwise. Chairman Gary Gensler quickly setting the record straight. But of course, it left it to the politicians, the GOP senators, demanding answers over the agency's cybersecurity procedures. Irony is not lost on anybody here. Let's start with our team coverage. Kaylee Lyons is in D.C. Sonali Basak is here in New York. Kaylee, let me bring it to you first of all. The Republicans are up in arms, but of course, there are a number of issues at play here.
Yeah, there absolutely are. The first one being, how could this possibly have happened on an official government X account? What we heard from the SEC yesterday is that there was unauthorized access to and activity on the account shortly after 4 p.m. That is, of course, when this false information was posted. That access has been terminated, and the SEC now says it's working with relevant authorities and partners in government to investigate what happened here. We also, though, have heard from X, the platform itself, which says its preliminary investigation indicates that an unidentified individual obtained control over a number associated with the account. And they also noted that that account did not have two-factor authorization enabled at the time of the compromise. So that's what we know thus far. But obviously, Manus, Congress wants to know much more. Congresswoman Ann Wagner, who chairs the subcommittee in the House that oversees the SEC, said that this is clear market manipulation that has impacted millions of investors. She plans to seek answers from Gary Gensler. And two senators on the banking committee, J.D. Vance and Tom Tillis, have written a letter to Gensler that says, in part, these developments raise serious concerns regarding the commission's internal cybersecurity procedures and are antithetical to the commission's tripart mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. So in many ways, Manus, the story of the actual journey to approval of a spot Bitcoin ETF may very well end today, as today is the deadline that everybody is watching. But the story over the investigation into the aftermath of this unfortunate incident is probably just beginning.
You got to say, the hack probably raises the hackles of much more aggressive regulation. You know, as we go forward, this is not going to leave anybody in the regulator happy. Kayleigh, thank you very much. Sonali Basak is alongside me. She's been on this story along with Kayleigh. I mean, here we are. We're waiting for the final announcement. BlackRock just didn't want to be left out, did they?
They did not want to be left out, and we know that because they have really been competitive on fees here. Something interesting here is the question, if it gets approved today, finally, when they start trading, how much money is brought into the system. We did see, on the heels of the fake announcement yesterday, Manus, Bitcoin barreling towards 48,000. We have it now crashing back down closer to 45,000. So there's your price differential in the immediate difference of approval or not approval of a Bitcoin ETF. Now, we know that there are other markets as well. They have went on just fine. You think about Bitcoin futures, for example. And when you think about regulation here, with what happened yesterday with the X platform and the SEC, you now also have lawmakers asking whether the SEC is appropriately regulating this market, given that their own snafu had led to such drastic price action here in Bitcoin itself on the heels of this mistake, if you will. So we'll see what happens today. We'll see what happens in the inflows into Bitcoin. Ultimately, that will be what sustains the price action, if indeed it holds.
Indeed, Standard Chartered pencil in 200,000 by the end of 2025. Let's see what the Flow Show can deliver on that. Kayleigh, Sonali, thank you very much. Meanwhile, to crypto land, the stocks are paying the price as a result of the SEC hack. Katie Greifeld is with me. Whose pain is greatest, Katie?
Whose pain is greatest? Well, you take a look at the price of Bitcoin right now on the back foot. Yesterday was an interesting dry run, of course, what the reaction to actual approval would look like. Initially, we spiked, then we went down, and we went down before we actually learned that it was a hack. So you add that together, it looks like a sell the news event. But I think there's an interesting blueprint here. If you zoom out and you take a look at the price of Bitcoin over the past 3 years. Remember that we had Bitcoin futures ETFs approved back in October 2021. We got close to $69,000 per Bitcoin, and we haven't been anywhere close to that level since. So we'll see if that, of course, is the same thing. But you take a look at the pre-market, or rather, the market is open. You take a look at Coinbase, et cetera, right now, all of those stocks on the back foot following crypto lower. So that's the crypto story. Let's take a look at the broader sector picture right now, of course. If you take a look under the hood of the S&P 500, you can see that we do have some green on the screen there. Of course, communication services up top. Then we do have consumer discretionary. You go down towards the bottom. What's on the back foot here? You have energies. You have materials. Energy have been having a very rough week. One bright spot is actually the airlines, which is interesting. Of course, you think about all the news and the pain that we're seeing with Boeing. Not so much if you take a look at the broader airlines, Manus, that index up about 4.5% over the past 7 trading days. Okay, well, I'll just leave you with this thought. I'm usually late to every party, so I was late to ESG. Will I be late to Bitcoin? Katie, thank you very much. Coming up in the show, market moving events to set your agenda for the trading diary.
Fed speak will be the key event for you this afternoon. You've got the New York Fed President John Williams, 3:15 Eastern Time, plus the deadline for, you got it, the SEC to vote on spot Bitcoin ETF applications. And if you're yearning for a bit of politics, the next Republican presidential debate kicks off tonight in Iowa. Thursday, you got it, CPI. In just over 25 hours, you will know where we are with the inflation narrative. We round out the week with the big bank earnings ahead of the opening bell. That was Countdown to the Open. It's New York. I'm Manus, and this is Bloomberg.